I'm Taylor Riggs in San Francisco in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, hitting highs. Tesla stock is on a rip-roaring rally, but does it have more room to run? We'll get analyst insight on performance as well as China production. Plus, appetizing. What were the most downloaded apps of the year? We'll have those lists coming up. And the year that was, we look at what 2019 meant for ride-sharing companies Uber and Lyft. Both went public with much fanfare. What does 2020 have in store? But first, our top story, the S&P 500 Tech Index on pace to have its best year in a decade, returning 46% so far this year. The last time we saw these types of gains, 2009, when the index returned 60%. To break down what's driving this banner year, it is Bloomberg's Mike Regan. Mike, what is fueling this massive rally?
Well, if you look at the main gainers in the main S&P 500 tech index, it's mostly chip makers. You know, you have AMD more than doubled, Lam Research more than doubled, KLA, Qorvo almost doubling. And I think there's been a lot of talk, obviously, on Wall Street this year about this rotation out of growth and into value. But I think that kind of oversells what happened. Growth has not exactly gone out of style. And it wasn't exactly a great year for growth for most chip stocks. But the stock market's all about the next big thing. And what are the next big things people are talking about? Well, 5G next year is going to be a big thing. A lot of chips needed for that. The Internet of Things is really still in the early stages. Machine learning, artificial intelligence, there's a lot of optimism built around these innovations. And the cloud computing arena is still not completely matured. You know, the next big thing used to be social media and your Googles of the world, your Facebooks and that sort of stock. Those have matured to some degree, and I think people are really looking forward to sort of that next big bump up in tech innovation that we're going to see in 5G and Internet of Things and on and on and on.
Mike, I want to come and take a look at a chart here that I'm showing inside my terminal because we talk about the massive rally, and I wonder if it means that the tech sector here feels a little bit overbought. According to the RSI index on the bottom of the chart, frankly, it is purely from a technical standpoint. What are you hearing from the street about the tech sector being overbought at this point?
Yeah, so the one thing about tech is it can get overbought and stay there for a while. So that RSI, it's been known to go above that 70 level that signals overbought and sort of stay there for a while. And when you look at that moving average, it is pretty high above that 200-day moving average. But again, this is a sector that's no stranger to sort of those extended rallies above a moving average. And that 200-day moving average is still pointed higher, which is a bullish thing, even if it comes back to test that level. You know, the trend, the long-term trend is higher. And it'll take a lot from a technical perspective to really break that uptrend that we've seen.
Mike, I was shocked to hear that hardware is actually outperforming software. Is this all on trade?
I think that's part of it. You know, obviously, when you look at the hardware sector, most indexes of hardware stocks, Apple far and away is the biggest weight in those indexes. But what's fascinating to me is really the best gainer this year among hardware, it's up about 87% for the year, is Xerox, one of the sort of old-fashioned tech companies. But I think there's a lot of optimism built in Xerox's attempt to take over Hewlett-Packard. I know Carl Icahn is on board with it. And sort of, you know, a situation where you would take two sort of ancient tech companies, combine them and basically get a lot, you know, squeeze a lot of synergy out of there and come out the other end with a sort of a brand new, leaner company that's in similar businesses but complementary enough that you know, people are getting excited about it. I mean, it's far from being approved, but a lot of that gain in Xerox came after the announcement of that intention.
And Mike, you know, we've Colin Rush. He's an analyst over at Oppenheimer waiting to talk about Tesla. So set him up nicely and talk to me about what has been going on with Tesla the last few days. Another day, another record, a 404 now for Tesla.
Well, here's a question I would like to ask him. You know, obviously when they introduced the Cybertruck, it was meant to have bulletproof glass. That didn't turn out to be the case. But so we saw an initial bad reaction in the stock after that. But boy, it's really rallied since then. The initial reaction from a lot of the analysts would be that this vehicle would be a niche vehicle. I kind of question that because, look, I come from rural Pennsylvania. I know a lot of pickup truck owners. It's a lot of people like landscapers, contractors, people who are driving their truck around a lot, and they're incurring very big gas bills. So pickup truck owners are notoriously loyal to their brand. But if they have the opportunity, these small business owners who are putting a lot of miles on their vehicles, if they have the opportunity to save a whole bunch every month on gas prices, I wonder if it's maybe a little bit more than a niche product that a lot of the analysts think it will be.
We'll find out. Thank you, Bloomberg's Mike Regan, for joining us. And as we've been talking about, Tesla shares now closing in on Elon Musk's goal of $420 a share. You may recall that back in August of 2018, he tweeted that he sought to take Tesla private at that $420 a share. This most recent stock surge, however, came from a report that Tesla is considering cutting the price of its China-built Model 3 sedans by 20% or more next year. Oppenheimer Managing Director and Senior Research Analyst Colin Rush joins me now over the phone. He has an outperform rating and a $385 price target. Colin, let me get your take over the share price in the last few days. At $404 a share, what's the fair value of this company?
Well, I think we have to talk about first what's going on a fundamental basis with the company. And, not only did we get some, rumors around potential price cuts in China, but we're seeing cars get pictured in the lots outside the China facility. And what the company's promised is a significant cost reduction out of that facility. And so that facility is ramping on schedule or even a little bit ahead of schedule. And they do get the synergies and the efficiency that they've been expecting. There's potential for, a material improvement in terms of their cost structure and their gross margins, which would drive the stock meaningfully higher. So as we think about that price cut, that may be indicative of where their cost structure is going to shake out and passing those savings on to consumers.
So do you look now at a $385 price target when shares are at a $404 and the news on China and potentially raise the price target into 2020?
So obviously we can't anticipate any price target changes, before we do them. But what I will say is that we're looking for more data, and this has been an extremely volatile stock, and so momentum does move in both directions. We saw the stock get oversold, earlier this year and rally, and we certainly have seen big moves both up and down. But what I will say is as we get more information about volumes, and there's a big push to finish off the quarter with strong volumes, and more information about gross margins and what's the potential earnings power is as they hit these higher levels of production, we will certainly reevaluate our price target and where we think the company can go. One thing I'll note that, since we published that price target and put it into place, Daimler announced that they're going to be laying off 10% of their management. They're going to miss the EU emissions targets, even after buying credits from other companies for zero-emission vehicles. And so we continue to see Tesla as having a 2 to 3 year lead from a technology perspective on electric drivetrains and powertrains, and we think they're leveraging that into market share, and will be able to continue to do so for the next 2 to 3 years.
Colin, you talk about market share, and I'm showing a chart to our audience right now, which is described to you over the phone, basically showing the car market over in China. Car sales have been falling pretty much for a straight year over in China. As you take a look at Tesla gaining, defending their market share over there in China, is cutting their prices by, let's say, 20% or more or so next year enough, really, to offset what looks like falling demand over in China?
Well, we've seen a handful of things in the China car market. So one, there's been incentives for electric vehicles, which were adjusted earlier this year. But even with that, we're seeing flat year-over-year EV sales, and that's battery electric vehicles. And so in terms of where Tesla's at in their market, just introducing the smaller vehicle with the Model 3 into that market, we see a larger addressable market for them. And it's always been a bit of a niche for them in terms of selling the Model S and Model X, which have both been global products, and China's been a minor part of their sell-through. And so as we look at them ramping the Model 3 production, we actually see them as a share gainer, particularly if they're going to drop price and start addressing some of the larger market on the low end.
And Colin, we know that the Model 3 was already the least profitable of all of Tesla's models. So does cutting a price by 20% or so change your profitability models and targets?
It really depends on what the gross profit is on a per vehicle basis. So the way we've really done valuation and potential cash flow analysis on Tesla is looking at how much cash they're capturing per vehicle, and what we've been seeing is somewhere around $10,000 per vehicle. And so if we continue to see that sort of number, flowing through with the Model 3 in China, on the volumes that they could begin producing, that would be something that I think would be a bullish signal for us.
And so as you look into 2020, how is their cash outlook? What could be the biggest catalyst for the stock as you see it?
It comes down to two variables for us. One, just to level set here, they've got about $5 billion of cash on the balance sheet. So we don't think they have any real cash needs, and they're generating free cash flow at the corporate level. And so the two numbers that we're looking at to drive the stock next year are really volumes, the number of cars that they sell, and what the gross profit is. We think they've done a nice job of controlling their operating expenses, and that there's an awful lot of operating leverage for them as they scale up this manufacturing. If they maintain their gross margins, we think there's real significant earnings leverage, and that will drive the stock higher.
Thank you to Colin Rush of Oppenheimer. And Congress has earmarked more than $400 million to help boost election security in early caucus and primary states where voting is slated to begin in February. Under the proposed spending bill, states would use the money for upgrading voting equipment, conducting post-election audits, and cybersecurity training. The nation's intelligence chiefs have warned that Russia and others remain interested in attempting to interfere in U.S. elections. And coming up, which apps were the most downloaded in 2019? We'll find out next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Facebook continues to buy companies in the hardware space as it's building its own operating system software. The social network giant is reported to hold talks about buying Cirrus Logic, a semiconductor company. It also announced the purchase of a Spanish cloud video gaming company, PlayGiga. Is this Facebook's attempt in advancing its hardware ambitions? Joining us to discuss it is Bloomberg Technology, Sarah Fryer. Talk to me about both the video game hardware and Cirrus Logic, folding this all really into their hardware ambitions.
Yes, so Facebook has really been focused on winning the future of hardware. Remember, they tried to be big on the mobile phone, but they couldn't make it. And since then, since the rise of the iPhone and the iOS operating system and then the Android operating system, Facebook has had to build its entire business in other people's ecosystems. Now, they did a pretty good job. They own 4 of the most popular apps of the decade. But in the future iteration of hardware, which might be AR glasses we wear or VR, Facebook wants to be the one that owns that hardware.
So talk to me about the operating system, because you just said they've built so much on Apple's iOS, Google's Android. What is this news potentially about an operating system on Facebook?
It would help them reduce their reliance on others, and it would really help them make sure that they can take apart, even if they create an operating system that doesn't end up becoming the dominant one, they can at least chart the path of the market. They can build something that other people have to compete with, and that helps them determine that a future that is more centered around social products, which is really what's most important to Facebook, is that whatever happens after the era of mobile phones, or in addition to the era of mobile phones, will have a big space for people to be connecting with each other over Instagram, Facebook, WhatsApp, Messenger, and the other properties they own.
Sarah, I want to look at a chart that I'm showing here inside my terminal for our audience. It's the forward PE ratio. We showed this chart yesterday, and analysts said that Facebook, as you can see here, really undervalued relative to some of the other big peers. A lot of this comes from the headwinds of regulatory scrutiny. How is Facebook continuing to make all of these acquisitions, even with this really big regulatory overhang on the stock?
Well, Facebook has really dominated in digital advertising and social media. And so if they were going to try to acquire TikTok, for example, or another social media app, it'd be very difficult for them to do that. If they want to acquire a gaming company, well, that's less concerning to the government, and they could probably get away with it. So I think that, yes, there is a lot of regulatory overhang. There are probably a lot of deals that could get done that aren't getting done because of that concern. But Facebook is going to keep trying to chug along 10 years, 20 years in the future on this hardware bet.
And it was funny, as we sort of wrap up 2019, we take a look at the stock. It's up more than 50%, 55% or something.
Oh, yes.
Do investors not care about data privacy, about antitrust? It seems like they don't.
They only care if Facebook stops growing or starts to slow down in their growth. And they have warned about that a little bit. They've said we can't continue to grow our revenue at the rate we've been growing it. These hardware investments are so much more expensive than the investments in software products. But investors are still betting that they'll make it work, that they'll continue to gain more and more territory over our free time.
I will be looking for that ad revenue growth for Facebook and Google as well as we approach 2020. That is Bloomberg's Sarah Frier. Thank you for joining us. And coming up, are subscriptions the next big thing? According to the top downloaded apps, they might be. We will bring you the list of 2019's top apps. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Closing a decade, 2019 has been a landmark year for mobile, with the rise of apps like TikTok and the launch of new video streaming services like Disney+. Here to discuss this year's big players in the world of mobile apps, Danielle Levitas. She's App Annie, Executive Vice President of Global Marketing and Market Insights. Great to have you. What did you find in your big report, sort of a key theme in the 2019 app downloads?
So I think the key thing we saw from a download perspective is that the big popular social and communications apps that really drive so much of our activity on mobile continue to dominate again in 2019. So if you look at the top 10, you'll see social apps were 7 of the top 10 in terms of downloads, with Facebook claiming 4 of the top 5.
One of those also in there that caught my eye was Tinder. How has Tinder's explosion changed the social media landscape?
So from a monetization standpoint, we're seeing that it's not just video apps or music apps that have done really well to monetize in entertainment outside of games on mobile, but we're seeing that dating apps are starting to make their mark. And Tinder claimed that #1 spot in monetization outside of games. And so I think it's an indication of the natural social experience of what dating can. It's a social component, right? This ability to quickly communicate. In the case of Bumble, you kind of have to check out you've been matched with within a certain time frame, like within a day before you lose those matches. So there's also behaviors to bring people back. And we're seeing more and more competition. Tinder has a huge lead, but we are seeing so many other apps in that space continuing to grow.
And what's interesting, and you've sort of hinted at this, is the ability to monetize. Some of the most successful apps that you've seen that were downloaded have those recurring revenue, that subscription model, which, as we talk about on this program, so important to investors. How are they able to be successful for a generation, frankly, that's known for not wanting to pay anything?
I think it's a matter of value, right? If you deliver a great value for a service that is not a one-time sort of fulfillment, it's built into the experience. It's sort of expected. And so I think when you look at entertainment, you're generally not just, you might be binge watching something, but you're coming back for the next show the week later. Or in the case of music, right? People are listening to music in many cases that are subscribers day in and day out. And then dating has that similar sort of like people are using these apps really regularly over a continuous period of time. So I think they've captured and delivered on a value and unmet need that people didn't have outside of it.
And a lot of the subscription-based latest apps that you were really highlighting here are within the gaming sector. That is really just taken off, the rise of this virtual sort of online gaming. Is that really what you see fueling growth as well into 2020?
So gaming's an interesting one. So overall in mobile, gaming drives about 75 cents of every dollar consumers spend. Now, if you look specifically in games, though, that's typically in-app purchases. So people are buying gems or levels. Subscription just started to take off with things like arcade this year, for example. And so subscription, I think, is something to keep an eye on in 2020. We just started to scratch the surface with games. It's the one area that games is sort of behind on versus other categories. And I think that it'll be a new opportunity for publishers to monetize games that maybe didn't lend themselves well to in-app purchases.
My producer used to be a sports broadcaster producer. So we talk about 9 innings in a game. Where are we in those 9 innings in terms of apps really being able to utilize engagement and monetization as you think about sort of a wide variety of where we are?
Engagement is everything. So if you start with the fact that we spend roughly 3 hours a day in apps, and of that, about half of it goes to social. So that leaves roughly 90 minutes for everything else. Now, some of that might be transactional. You're Venmoing somebody, you're potentially doing some other activities, ordering a ride, a coffee, et cetera. But then you have all this entertainment and so forth. And so engagement starts to become about either time spent or maybe it's more important to have sessions. So an app like Snapchat tends to lead in terms of sessions per user versus an app like Facebook that really is tremendously successful in social in terms of time per user. And so, but they offer a different social experience. And so it's important to understand which of those metrics are generally, correlated and associated with a happy consumer.
One app we haven't talked about yet, but we talk about a lot, is TikTok. Huge growth overseas. Do you expect to see TikTok as successful in the US? When does it actually take off here?
So from the standpoint of TikTok, it's phenomenal. The app has reached about 665 million monthly active users globally. We estimate in the US it's about 20 million. So it's starting, right? But keep in mind, TikTok does lean towards Gen Z. And younger consumers. And so I think with 20 million users in the US, we're already starting to see some material and impressive adoption. It's just, yes, people are also using Snapchat and Gen Z, especially in the US, Instagram and so forth. But I think we're already starting to see some compelling adoption of TikTok even here.
Danielle Levitas of App Annie, thank you for joining us, recapping all of those apps in 2019. And coming up, Tesla is considering a serious price cut to their China-built cars next year. What kind of price reduction? We'll have the breakdown next. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry On in New York and Paul Allen in Sydney. Let's take a look at those top global tech stories of the day. Paul?
Thanks, Taylor. Amazon's getting prepared for Brexit. Bloomberg's learned that the world's largest online retailer is looking for its first warehouse in Ireland. It will be used to fulfill orders currently shipped from the UK. Amazon would have a problem if the UK doesn't agree on a trade deal that would ensure the smooth movement of goods across the Irish Sea. WeWork is in talks to sell one of its businesses for less than a quarter of the price it paid 8 months ago. Bloomberg's learned that the managed by Q software unit could be valued at less than $55 million. A group of investors and tech executives are negotiating the purchase. WeWork's trying to cut costs and unload assets. Takeaway.com just raised its bid for Just Eat just minutes after Process upped its offer in last-ditch attempts of an ongoing battle to claim ownership of the UK food delivery firm. The Dutch group said on Thursday it increased its offer to 916 pence per share, with Just Eat holders to own 57.5% of the combined group. process also increased its cash offer to 800 pence per share, valuing the company at about $7.2 billion. And those are the top global tech stories we're watching. Sherry.
Paul, thank you. Tesla is considering cutting the price of its China-built Model 3 sedans by 20% or more next year. The car maker is betting the move will lure buyers as the world's biggest electric vehicle market slows. To discuss, we're joined by Bloomberg's Craig Trudell. Craig, so how much would this help in luring the mass market in China, especially when you consider the competition like XPeng, NIO? They already are much cheaper than Tesla, right?
Right. You do have a lot of electric vehicles and just cars in general that are priced, even some premium cars that are priced below where you see the Tesla Model 3. And, you know, when the price came out for the made in China Model 3, I think it caught a lot of people a little bit by surprise because it's not that big a difference. And the whole sort of reason for building this plant locally is the idea that they can bring the price down by avoiding import duties and so forth. But I think what you're seeing Tesla make a bet here is that, you know, there's going to be just a sort of natural sort of goodwill of getting a plant opened, getting governments on board. There are a lot of government purchases of electric vehicles in China, and Tesla making a bet that the sort of initial buzz about having the Model 3 built in China will itself kind of carry them for the first 6 months next year, and then you bring the price down after that.
Craig, I want to show a chart that I'm showing here inside my terminal, which is just sort of the big headwind and the macro backdrop that is slowing car sales across the curve, really in China for the last year or so. Is a 20% price cut enough to offset this drop in demand?
That's a really good question. I think if you're Elon Musk and you're looking at that chart, you're a lot more nervous about sort of the state of the China market than, you know, really if you look at when those drops were really sort of kicking in. It's around the time that Tesla was, you know, getting a deal, you know, signing on the dotted line to get this plant built. It was built extremely quickly. It's unusual for, you know, this was a muddy field in January of this year, and we're talking about a plant that's already, you know, opened and cranking out cars, potentially delivering them to customers and within the next few days or weeks. You know, this all happened extremely fast, and you know, we have seen some softness in the China market, but the degree to which the market really deteriorated this year, I think, caught a lot of car companies off guard, and it is a cause for concern if you're Tesla, despite the fact that you have you know, real brand power and a lot of star power as you know, a company that is sort of on the leading edge of electrification.
So, Craig, what's changed for Tesla that they can afford bringing the price down now instead of just from the get-go, given that some customers could just wait and hold out and not buy it and wait until prices drop, right?
I think that's a really interesting point, and it'll be interesting to see how long they can hold out before doing a price drop. You know, when you think about what Tesla has been up to this point, it's been a company that's made all of their cars in high-cost California. It's not, you know, it does not have you know, serious manufacturing you know, breadth across the world and in some lower-cost markets. So labor costs are going to come down significantly. You're able to avoid levies and tariffs and get special treatment in terms of you know, incentives and so forth. So definitely you could see that price come down further if the initial demand isn't quite what they're expecting here.
Craig, I want to show another chart here that I'm showing inside my terminal, which is basically the stock price at a record 404, blowing past everyone on the street's estimates. The median is about 291. I just got off the phone with Colin Rush over at Oppenheimer. He had a price target of 385. Even he admitted that the 404 has sort of blown past even his estimates. I know you focus on the company, but as you take a look at sentiment of consensus on the street, is there any sense now that at 404 at a record, Tesla's run on the stock price has been a little bit overdone?
I do think that you know, you just have to look at what the analysts have done with their price targets. They've been pretty stingy about taking those up, despite the rally that you're pointing out here. This is a company that did eke out a profit in the third quarter. They really loaded that report with a lot of positive things. Get people excited about the China plant being ahead of schedule. Get them excited about the Model Y coming early next year and that being ahead of schedule. There are a lot of things to be excited about. People are also, really pumped about the Cybertruck, despite the fact that I think, initial reaction to that was like, what is that? But I think this is a company that, is on a little bit of a run right now. That being said, you look at the financials, it is still a company that, is not making significant money. I think a big question is you think about how much people were caught off guard in the early part of this year, just with Tesla's inability to sort of weather the seasonal downturn that you see in demand for cars in January and February. You saw them cut a lot of employees very suddenly. That kind of scared everybody. You saw deliveries drop significantly. How they handle that seasonal dip that you see in car demand early in 2020 is going to be a real key for them this time around.
Craig, so we're now seeing Beijing trying to open up China's car market. Is that going to have an effect on Tesla, especially if we see more foreign car makers come in and try to do exactly what Tesla is doing?
It'll be interesting to see, because one of the things that we've been really following here in this market is you have had all the Tesla bears or skeptics talk about, well, just wait until the established car makers get into the electric vehicle game and Tesla's going to be toast. And that has not been what has come to pass. You've seen some of the big German car makers. You've seen GM, even Hyundai, Kia. They've brought electric vehicles to market that haven't hit the specs that Tesla manages to hit, and they just don't have the sort of brand power and excitement around them to where you've seen even the likes of like Audi or Jaguar put out decent looking electric vehicles. That's not so much the problem as maybe it used to be, where all EVs looked like science projects. But these electric vehicles are still really underwhelming, and you saw just the Porsche Taycan recently really sort of disappointed everybody with kind of an underwhelming range rating in the US.
Bloomberg's Craig Trudell, not only on fundamentals, but that record 404 price target we got on Thursday. Thank you for joining us. And much more ahead, so stay with us. This is Bloomberg. Now to our week-long series, Big Tech 2019 Rewind, where we look at the world's biggest technology companies and the challenges they faced over the last year. It wouldn't be 2019 if we didn't describe it as the year of the tech IPO, and it was one in particular that had investors they were waiting for.
It was supposed to be the IPO of the year, the ride-hailing startup that was supposed to be the world's most valuable, with a supposed market value of as much as $120 billion. But all of that changed during their debut, dropping nearly 11% in the first 2 days of trading. But while words like debacle were being thrown around to describe Uber's coming out party, CEO Dara Khosrowshahi remained optimistic.
You can't pick when you go public, but you can control how you execute as a company. But believe me, we believe that our business can and should be profitable over time.
Promising that the time frame would be 2021, and people agreed.
Investors want profitability, and you'll get that here pretty soon.
I don't see it as the end of the road. I see it as an important milestone. I think it was an achievement in terms of making that company available to public investors.
But since then, the stock price has continued to take hits, including hitting a record low in November as Uber's lockup expired. And despite a licensing battle in London and an Uber report disclosing more than 3,000 sexual assaults on its platform in the US last year, Uber remains optimistic.
The business itself can be quite profitable. We're confident of that. But the next 2, 3, 4 years are going to be about growth, and then we'll flip it over as the market demands.
Khosrowshahi spent the year cost-cutting in significant ways, shedding 1,000 jobs and rearranging divisions within Uber. And after watching other companies like LYFT and Peloton look lackluster since going public, Khosrowshahi's now thankful for that May 10th debut, telling listeners at the DealBook conference in November that, thank God we went public when we did.
To continue the conversation on Uber's performance in 2019 and its competition with Lyft, we're joined by Tom White of D.A. Davidson, and over the phone is Yigal Arounian of Wedbush. I want to ask you both the same question. Tom, I'll start with you. I want to show a chart that I'm showing in my terminal. You know the story better than anyone. Since the IPOs, both Lyft and Uber down 33, down 35%. What do you make of the performance year to date?
Look, it's clear. First of all, thanks for having me. It's clearly disappointing. I think what Uber and Lyft, part of the problem was that they were slow to detect and react to how investor expectations around demonstrating a path to profitability would be clearer. And investor sort of expectations shifted relatively quickly. Uber and Lyft were slow to react. Didn't really necessarily communicate very clearly that path. And investors punished them for it. I think the other thing that was interesting too here to keep in mind is, we've seen over the years, lots of high growth companies that went public when they weren't yet making money, but the IPOs were still relatively successful. I think in Uber and Lyft's case, and Uber's in particular, the sheer magnitude of the losses were something that investors struggled with. And I think that was a large function of how long these companies were private for before they decided to go public.
Yeah, Yigal, your take on the 35% drop.
Yeah, I think what you saw out of the market this year over the course of the year was less of a willingness from public market investors to accept large losses and on profitability. Really a kind of a record-setting year with tech IPOs. Uber and Lyft were ones that kind of led the class. And I think all of that kind of IPO supply led to some technical challenges. You also had Lyft and Uber and others that the trend kind of turned to stay private for longer. I think that sucked up some of the demand when they came public. There were a lot of lockups that expired, and that led to a lot of supply. So there were a lot of technical issues at play, I think, as well. And look, Lyft and Uber kept facing headwinds and negative news. There was a lot of the regulatory issues, the London problems, and other things that they disclosed over the course of the year, and that kept sentiment low. We'll look to see if that can flip over the course of 2020.
Tom, you mentioned a lot about the magnitude of the losses. You're going to have to clarify for me. When I went to my CFA school, we were taught that profitability meant on the bottom line, on net income. Somehow I moved to San Francisco, and people think that on an adjusted EBITDA basis, that's good enough to say that you're profitable. Am I being too hard on the companies, or is an adjusted EBITDA profitability good enough?
I don't know if it's good enough. I mean, unfortunately, in our industry, and my colleague on the line here can probably attest, a lot of times we even see companies who try and convince you to look even farther up the income statement, to things like contribution margin or gross profit. Look, at the end of the day, it's about cash flow for me, and sort of the present value of future expected cash flows. And EBITDA is a decent proxy for cash flow. Ultimately, though, GAAP sort of net income profitability is important as well. I think looking out into 2020, what's really going to be interesting is how Uber and Lyft manage that kind of growth versus profitability trade-off. Here in the U.S. market, I think it's going to be sort of iterative, sort of cat and mouse between the two companies. Uber really sort of in a position to sort of dictate where, how competitive the environment is for ride sharing when it comes to prices and promotional activity. But outside the U.S., Uber's going to have to make some really tough decisions, I think, about that growth and profitability trade-off. We're seeing them already make some of those decisions already. They exited South Korea, their Eats business. They're exiting in South Korea. There's obviously news reports over the last couple of weeks that they're going to exit Eats in India. And so, those are tough questions and big decisions that the company's going to have to make. And I think, they're going to clearly weigh how the public market investors are valuing those two things when making those decisions.
So, Yigal, let's get into some of those fundamentals. Clarify for me, some analysts I speak to like Lyft because it's a pure play on ride sharing. Other analysts like Uber because of their big diversification strategy. Is it clear in your mind yet which strategy will pay off?
I guess it depends over what time frame you're looking at, and our own view on that has kind of changed over the course of the year. Certainly, Uber's playing a bigger game. It's got a much bigger opportunity ahead of it, and if it can do the things that it's talking about doing, and rationalize in places where it needs to, the competitive environment, especially in rideshare, can start to ease up a little bit more. Then they do have a much bigger opportunity. But in the near term, international market competition is remaining really challenging. It's been much harder than I think most people expected it to be on the food delivery side, and I think that's going to stay competitive for even a longer period at this point. You're going to see consolidation in that space, and so on the international side, there isn't really that much clarity as to when things can ultimately get that much better and they could become profitable on an international basis. And so I think that is a challenge, and that's why when you kind of balance Lyft's domestic only and rideshare only opportunity with what Uber's trying to capture, Lyft's opportunity has become, or their opportunity to become profitable has become a little bit clearer. What's interesting is that Lyft highlighted expecting to become profitable by the end of, profitable as I guess it's debatable, right? As we're talking, right? But on an adjusted EBITDA basis by the end of 2021, and Uber is talking about getting there by the full year 2021. So that kind of goes against that whole concept that we're talking about here, that international and Eats would weigh down on Uber. I think a lot of investors remain skeptical about whether either can get there in that time frame. So there's a lot of show me for both of these stocks.
Tom, as you take a look at the regulatory landscape, AB5, particularly here in California, do you see these ride-sharing companies being able to overcome that? And if so, how much does the stock change?
Look, I think to an extent, yes. I do think Uber and Lyft have some levers that they can pull to offset the impact of kind of higher expenses, be it related to AB5 or be it related to surcharges that are levied against their businesses by cities like New York, but only to some sort of an extent. So, I think the bigger question is, Uber and Lyft have communicated that as their sort of regulatory expenses kind of increase, they're going to pass those higher costs, higher operating costs into higher prices for consumers. And I think to some degree, consumers will be able to withstand that. But if we continue to see sort of a flood of additional surcharges, I think one of the most egregious ones we've seen recently is sort of what's being proposed in Chicago, where it's like a sort of a tripling of the tax that the ride-sharing companies would have to pay. At some point, you're going to see that have an impact on ride volume. It's going to have an impact on just how attractive or appealing taking a ride-sharing ride is for a consumer relative to what the other alternatives for transportation are in a given city. And so, again, they have levers. They can increase price, but at some point you may see sort of a reduction in kind of the TAM or the number of use cases where ride-sharing really makes sense. I don't think it means that the businesses can't be profitable. It just means that maybe the businesses aren't as big as they were sort of pitched to investors on the roadshow or have as transformative an impact on transportation.
Yigal, biggest catalyst for the stock in 2020?
The biggest, I guess, potential catalyst will be competition easing. Competition is a huge factor. It's probably the most meaningful impact to profitability, and in markets where there isn't as much competition, each is significantly more profitable. So I think if we're going to get to a place where investors start to feel more comfortable with the market opportunity and the profitability, I think the single biggest thing is going to have to be competition continuing to ease. Without that, I don't think we're going to get anywhere really. And then secondarily, I think the regulatory environment is going to have to ease up as well. They're going to continue to battle in California. They're battling, Uber is at least in London. And, if we continue to get more and more examples of that, that's not going to change sentiment either.
And teaching me all about profitability on this Thursday, D.A. Davidson's Tom White and Igala Roonian of Wedbush. Thank you for joining us. And still ahead, we'll go through today's top tech calls, including why Pivotal is raising its price target for Netflix next. This is Bloomberg. Let's take a look at today's top tech calls. Netflix price target was raised to $4.25 a share. Pivotal Research Group, a move that comes in the wake of the video streaming company giving a breakdown of its international subscribers. The disclosure gave us greater confidence in our overall forecast, wrote the analyst. He reiterated a buy rating and sees Netflix as well positioned among streaming video companies. Grubhub's price target was raised to a street high of $52 a share at Canaccord, which expects order trends to stabilize at the online food delivery company. The analyst said that while 2020 appears to be an investment year, expanding restaurant selection and loyalty programs should drive gross food sales acceleration in the second half of next year. And Cisco shares gained after Barclays upgraded the stock to overweight from equal weight, citing a lowered valuation and new product announcements. The analyst says that Cisco has a diversified revenue stream and a few key product areas should improve for Cisco and the industry over the next year. And that was a look at your top tech calls. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.